A school teacher making $60,000 a year can pay a higher tax rate than a billionaire. That's not even a slogan. One investigation pulled real IRS records and found that 25 of the richest people in the country grew their wealth by $400 billion over 5 years and paid a federal tax rate of 3.4% on that growth. A lot of nurses pay more than that out of a single paycheck. It's not a loophole somebody forgot to close. It's built into the rules on purpose. And once you see the 3 pieces behind it, you'll never read a headline about a billionaire's tax bill the same way again. Kim's not sold yet. Fair enough. Let's get into it. None of what I'm about to show you is cheating. The IRS doesn't tax how rich someone is. It taxes specific events, income arriving, or a sale happening. If neither of those technically occurs, there's often nothing to tax yet. That one sentence is the whole trick. Everything else you're about to hear is just applying it over and over at a scale most of us never deal with. Concept 1. Say a founder owns stock worth $100 million. The stock doubles. They're now worth $200 million. Did they get taxed on that $100 million gain? No, because they didn't sell anything. It's still just a number on a screen. Compare that to a paycheck. The second that money lands in your account, it's taxed. No waiting required. Stock owned by the wealthy grows entirely untaxed for as long as it stays unsold, which is exactly how that 3.4% number from the intro happens. Some of the richest people alive haven't reported much taxable income in years because their wealth isn't income. It's untouched growth sitting on paper, which leads me to concept 2. And this is the clever part. Eventually, people need real cash to live on, and selling stock creates a taxable event. So instead, banks let you borrow against stock you already own, using it as collateral, the same way a house backs a mortgage. A loan isn't income. You're expected to pay it back eventually, so the IRS doesn't touch it. Someone worth $1 billion can borrow tens of millions at a low rate, live off that cash completely tax-free, and never sell a single share. It's called buy, borrow, die. And yes, actual tax professionals use that phrase seriously. It's not exclusive to billionaires either. Anyone with a paid-down house can borrow against it the same way. The math just gets dramatically more powerful the bigger the asset gets. Which brings us to the die part. The strangest rule of the 3. Pass appreciated stock to your kids, and the tax on all that growth doesn't just get delayed, it disappears. The asset's cost basis resets to whatever it's worth on the day you die. So that $100 million gain from concept 1, if it's never sold during that person's life and passed down instead, nobody ever pays capital gains tax on it. Not the parent, not even the kid who inherits it. That gain just legally disappears from the system. Stack all 3 together and the pattern gets clear. Hold the asset so it never gets taxed. Borrow against it so you never have to sell it. Then pass it down so the tax bill resets to 0. 3 separate rules, each one reasonable sounding on its own, that happen to line up perfectly. One more, and it deserves a mention, even if we don't linger on it. Donating appreciated stock straight to a foundation skips the sale tax entirely and still counts as a deduction on top. It's a genuine gift, but it also lowers the tax bill more efficiently than donating cash ever could, while the giver often keeps a hand on how the money eventually gets used. Put the 3 together. Growth that's never taxed while it's growing. Loans instead of sales to access cash. And a reset button at death that erases the gain for good. None of it needs an offshore account or a shady accountant. It's sitting in plain sight in the tax code, available to anyone with enough assets to use it, written into law by the same people who get asked to close it. The honest takeaway isn't, go do this tomorrow. Most of us don't have $100 million in stock lying around. It's understanding that the tax code taxes paychecks a lot harder than it taxes wealth. And that's not an accident of nature. It's a choice, made line by whoever writes the rules. Every one of these 3 ideas exists because a lawmaker decided it should. So next time a headline tells you a billionaire only paid some tiny percentage in taxes, you'll actually know why, and you won't need anyone to explain it to you again. If this made one confusing headline finally make sense, subscribe. There are more of these breakdowns coming. Thanks for watching, and I'll see you in the next one.